Let's bring in CNBC contributor Peter Boockvar, Chief Investment Officer at Bleakley Financial Group. Before we get to that, Peter, I want to bring you into this conversation that we're having, very heated one on the desk. When you take a look at this market, is this trying to tell you something, this huge boom in AI at the expense of industrials, staples, materials, et cetera?
Well, two things. If you look at, let's isolate the 8 companies from the 492 and then throw in the 2,000 and the small cap Russell. Well, those 2,500-ish companies are customers of those 8. So you can't have the 8 going up like this while their customer base are experiencing their own weakness. And with respect to extrapolating the AI craze and to think that this is going to be great for the broader economy immediately, and this is the beginning of a takeoff in the stock market, well, the Apple iPhone was initiated in 2007. That wasn't the best buy signal for the broader market, and it certainly was no tell on the broader economy.
Okay. Let's talk about the jobs report now. What are you expecting, and is this going to give the Fed any reason to pause here?
So the estimates right now are under 200,000, and if the case, it would be the second month in a row below 200,000. The last time we saw that pre-COVID was 2019. I thought noteworthy was in today's consumer confidence number, where we saw weakness in the employment figures. In fact, those expecting more jobs over the coming 6 months fell to the lowest level in 7 years. So I do think that there's risk to the downside. But again, the Fed wants to see a weaker labor market. I think the Fed is pausing, regardless of what Friday's number is. And Friday's number is backward looking anyway. So any central banker that's going to base their decision on Friday's number is really bad rear view mirror type analysis.
Peter, it's Tim. So speaking of rear view, I mean, let's look back at the banking crisis. I was looking at your notes. I agree with you, and you know that we're probably the impact of SVB and the retail bank, the regional bank run is 100 basis points. Where do you think the Fed is in terms of their ability to really forecast this? And I think I know the answer, because there are many different forces that I do think are negative for the economy, and I think ultimately are negative for stocks. But right now, the Fed, if anything, has been talking rates higher. They've been talking up Fed fund futures. There's no sense, we had 120 basis points of cuts before the year end. If you asked us 3 months ago, now you're down about 15 basis points. So where do you think we are in the Fed's thinking?
I think humility is very important here. Since SVB collapsed, we've had 50 basis points of rate hikes, and based on some estimates, the credit crunch and / contraction is the equivalent of an additional 50. So you've had essentially 100 basis points of rate hikes since SVB collapsed. Just humility should tell you that the Fed should take a pause. And I'm not saying that they stop raising interest rates. I'm not saying they need to back off from this inflation fight. But wouldn't it be prudent from a risk management standpoint to take a step back? Because to your point, Tim, we don't really know how this is going to play out over the next 3 to 6 months. And if you don't really know, why would you then go raise interest rates? Shouldn't you raise or make a policy decision like that based on more confidence than looking at, okay, what's happened in the data today, which is reflecting what's already happened in the economy?